Namaste students. Let us proceed with the understanding of a few more accounting terminologies that are frequently used in this subject. In the previous lecture session, we have been introduced to words like entity, transaction, the kinds of transaction, assets, and so on. So let us continue with learning of these simple terms which are frequently used in our subject. So here in the previous session of mine, I have explained you all about assets and kinds of assets. We learned that assets refer to the utilization of the funds. Now, the business gets funded by means of capital. Principally, the money invested into the business is referred to as its capital. Now here, we are going to start our lecture session on the term liabilities. So what does liabilities mean to us? Any business to get started requires its capital or its investment. And it is a common sense that we understand that this capital comes from that of the owner of the business. So the surplus funds that the owner has got to invest with the business activities is referred to as the capital of the business. Now here, whenever this money, capital, being invested by the owner of the business is insufficient to run the business activities, there is every tendency that the owner resorts to a certain borrowings. So these are referred to as borrowed funds. I would like you to recollect with the business entity concept, wherein we understand that the individual is different from that of the business that he conducts. So here in accounting, the recording of the transaction happens by means of business entity concept. The individual who starts the business unit, let us take an example of the sole proprietorship. One single person owning, managing and controlling the business unit is referred to as a sole proprietorship form of a business organization. Assuming that one single owner is starting the sole proprietorship, the individual is viewed differently from that of the business unit. So here, we understand that that individual who is supposed to be the owner of the business unit is giving capital to his business. And in this way, capital is understood to be a liability to the business enterprise. On the closing of the business, the individual, the so-called owner, has every right to take back his capital money from the business. So here, what does liability mean to us? Liabilities are the obligations of the business enterprise payable to the outsiders. When I say outsiders, it refers to the borrowed funds. Also payable to the owners of the business. Here I mean the owner's capital. So naturally, liability is said to be the combination of the owner's funds and the borrowed funds. Owner's funds is referred to as capital. Borrowed funds is referred to as external liabilities in the form of loans and such other things. So here, liabilities represent the sources of funds and they represent also the obligations of the business enterprise which needs to be payable both to the owners as well as to the outsiders of the business. So we can cite owner's capital, borrowings, including creditors and bills payable to be the examples for liabilities. Let us examine what are the various types of liabilities that we can think of. So on the basis of the time period, the liabilities which exist for a longer period of time in the business are termed to be long-term liabilities. As in the case of assets, the period here would be taken as a period of 1 year. Thereby, the liabilities which remain for more than 1 year's period of time in the business are referred to as long-term liability. When I say remain in the business, it means that payable. So therefore, you can make the payment of the liability after a period of 1 year. The examples could be the owner's capital. The owner's capital can never be withdrawn immediately. As long as the business continues, the owner's capital remains over there. Only on the closure of the business that the owner will be capable of taking his money back. Similarly, the long-term loans that are taken by the business enterprise, say a 25-year period loan. So this needs to be paid back only over the period of the time. So necessarily these are the examples of long-term liabilities. When it comes to current liabilities, these refer to the liabilities which needs to be paid within a period of 1 year's time. So it should be payable within 1 year. And generally these current liabilities refer to the short-term money arrangements made by the business. So in order to run smoothly the business activities, to carry on the day-to-day activities of the business, they take a short-term loan or short-term borrowing. So this would be termed as a current liability. For instance, it could be creditors, bills payable, bank overdraft, the loan taken against the current account balance of the businessman, or a short-term credit which happens to be within a period of 1 year. This would be termed as a current liability. Let us examine the term capital. Capital refers to the investment made by the businessman. In a layman's sense, we say it is the investment that is made by the businessman into his business activities. Then, in accounting terminology, we say capital refers to the investment of money or money's worth. So, directly money could be invested, or even sometimes money's worth could be invested. What does this money's worth mean? That the businessman brings other than money a certain things. For instance, he may bring in some furniture, or he could get some land or building into the business as in the form of investment. So that is the reason why we define capital as the investment of money or money's worth by the proprietor or the owner. Generally, the proprietor or the owner, it could be one single owner or it could be group of owners. Take for instance, it differs from the form of organization that we are talking all about. If we are talking about sole proprietor, all of you know that it is a single person who would own the business. When it comes to partnership, there are a group of people known as partners who are the real owners of the business. When it comes to a joint stock company, the shareholders, they are more in numbers. So all these shareholders become an equivalent owners of this company. So it depends on the form of organization that we are dealing all about, that the investment of money or money's worth made by the proprietor, or it could be plural, the proprietors, the owners, to start a business concern, it is referred to as capital. Capital is understood as a liability for an enterprise. That is, the business has to give back the money to its owner when the business is shut down. As such, the capital has to be returned back by the business to the owner in the form of returns or profits. When even the business is continuing, that there should be the returns in the form of profits to be given to the owners. When the business is shut down, the capital being invested by the businessman will be returned in total to the businessman himself. So that is the reason why capital has to be understood as a liability to the business unit. Now, I will introduce the concept of balance sheet here. This is a magical statement, a table which puts forth things in its proper place to give you a better understanding of the basic terminologies that we have learned so far. Now, let us consider this as a statement. So, you have on the left hand side a word by name liabilities, and an amount column is being given, after which we have the heading, the title as assets. Now here, what does liabilities refer to as? Liabilities represent the sources of funds. So let us examine the whole statement to be a reflection of what a business activity is being done across. Now to begin with the business activity, that you need funds. how do you get funds? In what form do you get the funds? Through the capital. That is the money invested by the owner of the business. This is what we term it to be owner's capital. Look at the left hand side of the table. On the liabilities column, we have the first item being recorded as owner's capital. This represents the surplus money invested by the businessman on his own name. That is owner's capital. In case if this capital is not sufficient to continue the business, then what does he do? He borrows money from the outsiders, maybe loans or maybe from known people, maybe from the financial institutions. So this becomes a part of the outside liabilities. So the total liabilities comprises of both owner's funds, owner's capital and outside liabilities. So this forms the total liabilities. What does this total liabilities represent? It represents the entire sources of funds that is being invested into the business activities. Now the businessman does business. With this money, whatever is available, his own capital and the outside borrowings pooled up together, he has a vast financial resources and he is going to apply this financial resources and do the business. In the course of business, he may have to invest this money and change its form. If he retains likewise in the form of cash, then it is considered as cash in hand. In case if he feels unsafe and goes to the bank and deposits it, it becomes cash at bank. If he feels that he has to buy goods for selling it in the market, goods also become the properties of the business which are termed as current assets. So likewise what happens is when the business person is utilizing these funds into various activities of business, these activities or these investments put forth are referred to as assets. So in what forms does assets exist? Assets can either be in the form of fixed assets, it could be in the form of current assets, and it could also take the investments form. Fixed assets are those which are retained in the business for more than 1 year's period of time. You know that they are not meant for immediate sale and they would build up the basic infrastructure of the business unit. Maybe when you visit the college, you find chairs, tables being provided, desks being provided. All these you cannot take it home when you go home. At the end of the day, they remain over there. And for your convenience, they are being placed. These are fixed assets. In any business unit, for instance, you visit a supermarket. You find some trolleys, you find some computers for billing purposes. These could be termed as fixed assets. They are kept in the business for increasing the profitability advantage, but not meant for immediate sale. Now, when you move on to current assets, the current assets are those assets which are capable of being converted into cash or cash equivalents within a period of 1 year. Normally, the floating kind. It is like, you have to use this in the day-to-day activities of the business are termed to be current assets. Could it be stock, cash in hand, cash at bank, debtors, and so on. And after investing your money, capital or your liabilities in the form of both fixed and current assets, if you still find surplus and if you feel like there would be good returns in the market when you invest your surplus money, then you go out of the business and try to invest your money in something else. Maybe in a bank, maybe you buy the shares of any other companies. These are termed to be investments. Now look at the entire chart once again. On the left hand side, the total liabilities represent the total sources of funds. The assets represent the utilization of funds. In what different forms have you utilized your money across? Now together forms a statement. On any given date, since I'm talking about a statement, I mention it specifically as a date. I am not referring this as a period. The word period is different from that of the date. Period refers to a series of dates. It could be a month, it could be a year. But this balance sheet is a statement which has to be prepared on a particular date. For instance, you take your academic year. Academic year is a period. You are studying your class 11, first PUC class, for a period of 1 year. That is referred to as a period. But when it comes to mark statement, you write your exams and your teachers correct your answer scripts and give you the marks. You receive a mark statement. The mark statement is given on a given date, a particular date. It is a statement. So I hope you understood the difference between the word period and the date here. Balance sheet is a statement which is prepared on a single date which consolidates the period's achievements. So 1 year, what all that the business unit has done over through the year is projected or plotted on a single date. So on the date of the preparation of the balance sheet, you should understand that the total of the liabilities must and should be equal to the total of the assets. Because nevertheless, the total sources of the funds can never vary or change with that of the total utilization of the funds. If I give you a 100 rupee note to spend across or to use it, only a 100 rupee note is available with you. So maximum what you can do with is with 100 rupees. So naturally, the total of the sources of the funds must be equal to the total utilization of the funds. So this is what we understand by balance sheet concept. So here, total assets on a given date would be equal to the total liabilities. You know pretty well that liabilities comprises of both owner's funds referred to as capital and borrowed funds referred to as outside or external liabilities. Now, can you change this equation slightly better to put it across as assets minus outside liabilities, meaning borrowed funds, will give you the owner's capital. So, you are just modifying the LHS and RHS to make the equation more meaningful. These equations, total assets is equal to total liabilities or assets minus borrowed funds is equal to owner's capital, are referred to as balance sheet equations. And they depict the financial health or financial position of a business unit at a given point of time. So usually we understand that if the assets are more by their quantity or by their quality, if the assets have an upper hand in the business than the outside liabilities, meaning borrowed funds, we say that the business unit is having a sound financial record. So assets must be more than that of the borrowed funds. Then we call it as a healthier financial position of the business unit. Now let us proceed into a different direction of our study. We are going to discuss on a few other terms which are frequently used in our subject. I will take up the study on a particular word called income. What does income refer to us? Generally, I told you that the money is being invested by the businessman in the form of capital. Capital being a liability must give a certain return to the business person. So this return, while the business is being continued, is understood to be profit. So the profit is the return on the liability called capital, which is given back to the business person. Now here, during the course of the business activities, we generate a certain revenues and incomes. When the business activities are conducted and returns are being made, we call it as sales or the revenue from operations. We have seen that sales indicate the revenue from operations. These itself, the revenue from operations, are understood to be the income. That is what the firm earns. So income might be from the sale of the goods, or if you are service-oriented industry, for instance, you take BMTC. What is the revenue for BMTC services? The passengers pay the ticket money, and that entire ticket money collected refers to the income of BMTC. It doesn't sell buses, it runs buses. So when you take a Tata company or when you take Maruti company, it sells automobiles. Car sales are being done. So the income for Maruti company would be the income generated out of selling cars. Whereas for the BMTC, services are provided. So income that is related either to the service providing or to the selling of the goods. Sometimes there are companies or there are business units rather which do business with the financial part. For banks, for instance, or you take the loan givers, creditors. How do they make their income? They make their income by receiving the interest money. They are going to give away a large money in the form of loans, and what is their income for them? Their returns would be the interest received by them. Sometimes you find landlords who rent out their buildings and they receive rent. But that is their principal business. You should understand that the money received out of the regular business activities of the businessman is termed to be the income of the businessman. Now, these incomes are understood to be recurring in nature, that is continuity will be there, and it is raised on account of the regular course of the business activity. When it comes to gains, some profits arise in a non-recurring manner. That is, there are a certain abnormal transactions which result in the raising of extraordinary revenues into the business, and these are termed as gains for the business concern. You take for instance the lottery prize received. Now lottery is not the regular business. Like suddenly some kind of lottery money has been, being a stroke of luck that we have received a lottery money. Every time we cannot foresee receiving a lottery money. Similarly, I had a huge building and that building was getting old. I had no intention of selling it, but then now there is a compulsion that I need a new building to my workplace. So I intend to sell my old building. When I sold it, I received a huge profits on account of that building sale. So that also every time I cannot expect selling a building and making money. If I am doing that, then I become a real estate owner where I trade with buildings. You should understand that aspect. So if I am a business person, not trading with any buildings, but my building, my personal building has become very old. I intend to sell it and buy a new one. And in this course, if I have made a huge profit out of it, this is an abnormality of profit that comes. I am not trading with the buildings at all here. So sale of the fixed assets has resulted me in making a huge profits. So these are the examples of gains that is made in the business unit. Then we will move on to two other relative terms, expense and expenditure. Expense refers to any kind of expenses that are incurred in the course of the business activity. During the business activity, when you are incurring some money, that are referred to as expenses. Now, when I am doing business, I need to buy raw materials, or if I am a trader, I need to buy goods for selling them in the market. If I have employees at work being employed, I need to pay them their wages and salaries. So likewise, all these things will incur some money out of my business to be paid to the outsiders, which are termed to be expenses. And understand students, these are incurred during the regular course of the business activity. On the other hand, there are certain circumstances where you need to spend maybe a larger or a smaller money unusually in order to incur a certain liability in the business. I refer to as a liability being incurred. Maybe like you buy a property. When you are buying a property, what happens? A huge money gets blocked up over there. You buy a land, a piece of land, so that you are going to use it for building purposes at a later stage. Or you are buying a built building. So here, you are incurring a liability out of your money in an abnormal way. This is not again recurring in nature. It is not pertaining to the regular course of the activities of your business. Such spendings are referred to as expenditure. If I have to explain you in accounting terminology, expense refers to the revenue part and expenditure is related to the capital part. Revenue indicates the day-to-day activities, regular course which is recurring in nature, and capital items are referred to as abnormal items which happen not regularly. They are non-recurring. So expense is incurred in the regular course of the activity. Expenditure is incurred once in a while, which is non-recurring in nature. Here comes a word interesting, discount. All of you must have heard about this word discount. There will be, big billion sales and a lot of, online sales that happens now and then. Even when you go to business units, during the festival season. So there would be big boards hanging on to saying that great discount, avail facility. It's a short time period facility. So what does this word discount mean to us? It refers to some kind of reduction in the price of the goods that are being sold to us. So a reduction in the price of the goods that are offered to the customer is referred to as a discount. Discount can be of two types. Either it could be a cash discount or a trade discount. Normally, trade discount is the discount that is being given on the list price of the goods at the time of the sale. This trade discount is offered to the customers on the bulk purchases of the goods. So we say it is a bargain price. So here it is offered on the list price of the goods. When it comes to cash discount, this cash discount is usually offered on the prompt payment of the money. Meaning here, it is offered only for those who give the repayment on time. So here we understand that discount refers to a reduction in the price of the goods, and discount can be of two types, trade discount and cash discount. Trade discount is allowed to a customer on the basis of the quantity of goods purchased, and this trade discount comes from the list price of the goods. Also remember students, trade discount is not to be entered in the books of accounts. When it comes to cash discount, it is the discount that is allowed to a customer for making a timely repayment of the money taken by the customer. Here comes a word called voucher. What does voucher refer to us? Voucher is understood to be the documentary evidence in support of any business transaction. When the transaction is being done, we require an evidence in support of the transaction, that too in a written form. You go to a shop and buy a certain thing. Say for instance, you go to a medical shop to buy some medicines. And you bought those medicines, they have delivered the medicines and you are making the payment. What is the proof that you have made the payment to the shopkeeper? He gives you a bill. So the bill is a documentary evidence in support of the transaction that you have made the payment. The bill will contain all the details of the medicines that you have purchased from the shopkeeper. It acts as a documentary evidence both for the seller as well as the buyer. The seller will have an idea as to what medicines he has sold you. The buyer, you will have an idea what medicines you have purchased from that seller. Also, it tells you that you have already finished making the payment to the seller. So, voucher is any documentary evidence in support of a particular business transaction. So, these vouchers are referred to also as source documents. Meaning, in case of any verification of the accounts to be done, supposing you suspect any kind of fraud or any kind of suspicion is there in the business transaction, these vouchers act as a supportive document in order to clear those suspicions. In fact, they also act as a evidence in the court of law also. So, could there be an examples of these vouchers? Could it be bills, or it could be, the stock registers that are being maintained, and wages are being maintained in the form of affidavit signatures. All these would serve as our source documents. Let's move further. The next word that we are going to deal is all about goods. Now, when you take assets on the balance sheet, you find that assets refer to the utilization of the funds, and assets are categorized into fixed assets and current assets. When I speak of current assets, we understand that the assets which can be converted in the form of money or money equivalent within a period of 1 year are referred to as current assets. Among the current assets, goods are an important current asset. You should be able to distinguish the word goods from assets. Assets are not meant for immediate sale. They remain in the business to improve or increase the profitability of the business. On the other hand, goods are something that is bought by the businessman in order to sell them immediately in the market in order to make more money. So the products in which the business concern deals with either for production or for sales is termed to be goods. Now, not always that one particular item is a good for every businessman. Let me just explain you with an example. You go to a supermarket and you find trolleys over there which is referred to as assets. You find computers in the billing section. Go and ask that person standing near the bill counter, is this for sale? He will laugh at you and say, no sir, this is not meant for sale. So the computers are maintained in the supermarket to increase the billing capacities, and they are using it so that the customers are satisfied. More number of customers would come because the billing time would be reduced by the use of the computers. These computers which are used in the supermarkets for the billing purposes are termed to be their assets, not goods. Go to a computer shop which trades on computers. There you find a lot of computers and these are meant for sale. In the supermarket, the computers which we termed as assets now become goods for the computer seller. So I want you to understand that these goods differ according to their usage and meaning over there. So if the goods are meant for sale, then the things which are meant for sale are referred to as goods. The things which are kept in the business are referred to assets. And these will differ from the business person to the other business person. Now here when you are talking about goods, also you understand the meaning of the word freight. Freight refers to the cost for transporting the goods. When you are paying the cartage for moving the goods from one place to another, it refers to as freight charges. Goods can be classified under 4 broad categories. Could it be purchases, purchase returns, sales and sales returns? The same classification of the title for the goods I am talking about is categorized as 4 different categories. Purchases refers to the goods which are being purchased. It only refers to the goods which are being purchased by the business person. And remember, the goods, the meaning of the goods is retained here when you talk on purchases also. They are meant for either manufacture if you are talking about raw materials, or they are meant for resale when you are talking about finished goods. And it includes both cash purchases as well as credit purchases. And when you move on to purchase returns, you buy a certain goods and they are not up to the mark. You have already brought them, the delivery has happened. When you opened that and saw that it is not according to your specifications, then you go to that seller and say, see, I have ordered you to deliver these kinds of goods, but what you have delivered is not up to the mark. Take them back. So when you are returning, for any reasons that when you are returning already the goods purchased by you, then it is referred to as purchase returns. Purchase returns are also known as returns outwards. Because the goods are going out of the business over here, we use the term returns outwards to refer to this purchase returns. Also we have in the list the sales. So here the term sales represent the goods that have been sold, that have already been sold or dealt by the enterprise. And here the sold goods can also be into the category of cash sales or credit sales. So when you sell them for cash and you have already received the money against the selling of the goods, it is referred to as cash sales. Still the money is yet to be received by you, then we term it to be credit sales. Sales form a part of the revenue in the business. So we call them as revenue from operations. Now after selling, if the customers feel that you have not supplied them with a proper category of the goods, they also will have the tendency to return it to you. So these kinds of goods, what you have received on the return basis is what you term them to be sales returns. So sales returns are also popularly known as returns inwards. Remember students, the word goods, the recording of the transactions avoids the word goods as it is, and instead of using the word goods, we use it on the name of either purchase or sales, or it could be purchase returns or sales returns. That would give us more clarity and more information for our recording purposes. Well, with this explanation of mine, I end up today's lecture session. Have a wonderful day ahead. Thank you.